Hello, everyone, and a warm greetings to all of you. Welcome to yet another webinar by Mirae Asset Mutual Fund. So, today's topic is very interesting, a tale of two central banks. Herein, we'll be discussing two pivotal decisions taken this very month. One by the US Federal Reserve, which is yesterday, which was, to hold on to rates, and the another towards starting of the month by the Reserve Bank of India, which was a surprise rate cut, both announced on the back of complex global dynamics. Over in Washington, the US Fed opted, to pause after holding the federal funds rate steady at around 4.5%, citing reasons like, inflation, especially from tariffs, and a mixed growth outlook. Chair Powell also emphasized a data-dependent approach, cautious stance that signaling that any move towards, easing will hinge on clearer disinflation trends. Meanwhile, at home in India, the RBI governor led the MPC in delivering a 50 basis points rate cut alongside a 100 basis points CRR reduction, shifting from an accommodative to a neutral policy stance. With the CPI inflation cooling down, the RBI has front loaded cuts to support growth and liquidity. So these two contrasting approaches reflect a split in global economy, wherein a US is still battling with sticky inflation and in India is ready and poised to press on the growth accelerator. So this becomes a very interesting scenario, especially for the fixed income investors. It also opens a lot of opportunities in yields, duration, credit, accrual, etc. So, to know more about the same, to talk more on the same, and, to understand how do we navigate this very, global headwinds at the time wherein we also have strong domestic momentum. Today we have with us Ms. Kruti Chheta, fixed income analyst and fund manager with Mirae Asset Mutual Fund. Welcome, Kruti.
Thank you, Tanya, and thank you all the participants for being with us in these interesting times.
Right. So viewers, just for your understanding, how will we intend to approach this webinar is in a Q&A format that, I'll be asking Kruti a few questions, that's on all of our minds, of course, and she'll be answering that, and post which we can have questions by our participants in the chat box. So, Kruti, let's dive right into it. So, yeah, my first and foremost question to you would be, this is a fourth consecutive pause by the FOMC. So, what is this displaying? A stability or sort of a cautious approach by the US Fed? What's your take on the same?
So yesterday's policy, if you see, largely is a non-event. It's all in the line of the expectations, whether you see the stance, whether you see the rate decision or the dot plot in itself, where it is maintained where it was last time. Your growth was expected to come down, which has come down. Your unemployment and inflation was expected to tick up in the forecast, which has happened. So all said and done, the event in itself has been a non-event kind of a policy. But if you have to listen to the press conference and have few key takeaways from the press conference, I would like to point out a couple of things out there. First is that if you listen to the speech of the of the Fed chair, you would see that now there in this speech there is much more confidence, which was not there in the last, I would say, 2 to 3 policies, because the government policies in itself were not clear that where they were heading or what announcements were to be made. Now there is clarification as to what policies are expected to be in place and how things can possibly pan out. So there is more certainty, and there was a statement which was given that there is a diminishing uncertainty now, and there is more of certainty that is gaining traction. Second is that there are two thoughts of processes within the members that are there. One is that one set of the members are who are on the pause, or rather one cut for this year. They are awaiting more data. They want to be driven more of data, because in all fairness, at the beginning of the year, we started with inflation going up to 5%, growth sharply decelerating, and all the predictions have not played out as per what it was predicted at the beginning of the year. So there are some members which are thinking that there should be more of what do you say data that has to be translated into hard data. If inflation is likely to come that much higher, then we will accordingly react to it. Second thought of is that the monetary policy has to be forward looking, where we are seeing that the members are predicting two rate cuts, saying that now the uncertainty is back, decreasing, and we are getting more clearer picture, then we might as look and decide on the forward looking part. So this policy, I would say, many read it as completely hawkish policy. There is also a positive twist to it, because there are some comfort which is coming, I would say, which was not there back in the 2 to 3 policies. Therefore, uh, stability, yes, back on the stability, and not completely step down from the caution, but a step towards a more of a stable policy, I would say, it was the yesterday's policy. Uh, Tanya, you're on mute.
Yeah, so sorry. Yeah. Yeah, so while you shared on the Fed policy, now if you look at the RBI's MPC, which happened towards the starting of the June, both look a little diverging. So how do we interpret the Fed's decision to hold versus, the RBI's decision to cut? What does this divergence signal about, especially, in the whole global backdrop of inflation versus growth trends?
So, this question keeps arising again and again, because we have seen that the past trends, they say that the policies are aligned to the Fed decision, and whenever Fed sneezes, the whole world catches the cold. But past, if 6 months has been, it has been diverging policies across the developed nations and developing nations, and especially if you see the past 3 months trend, the developed nations, the yields have gone on the upper side, whereas the developing nations, it has emerging nations, I would say, has gone down. And this is a trend across any nation that you take. The reason that is happening is that because the developed nations now have some of the issues which they are coping up with, which emerging economies don't have, such as heavy debt to GDP ratios. Their fiscals have been expanded. This all is a fallout from the COVID measures that they took, which was not constrained at that point of time. Whereas the emerging nations did not have that much of scope to, provide so much of a fiscal stimulus. So because of this, since the COVID time, there has been a divergence in the approach in itself, how the monetary policies have shaped up. And we saw this even post COVID, the first decisions to decrease the rates for some of the emerging economies, and it continues. So there is a wide trend. As per domestic and Fed, if we have to see, RBI has fully front loaded the decision, and the reason being that we are only looking at the domestic factors. You be it, and we are in the checkbox. The inflation is well below the 6%, I would say 5% target, which is there at the lower band of the target range. Your fiscal is well in check since last post COVID. Last 3 years, we have gone on the declining fiscal. We are doing the fiscal management very well. Uh, Rupee has been stable. We saw a couple of months of volatility, but we handled that also very well. So, and compared to the other emerging economies, rupee has been less volatile if you see in the larger scheme of things. So, be it we have checked, box everything. So now the time is for the domestic as the economy to think that we need to accelerate on the growth, and if these are the measures which are to be taken, but might as well be so. We cannot keep depending on the global policy for our growth acceleration. And if global is going to slow down, India will slow down. But how do we outpace the growth is something that is in our hands. And that is what the RBI has done so far. It has front loaded the entire rate cycle, saying that we are doing whatever we can in the shortest time, and so that the translation happens very fast. And you've seen that the liquidity also from the negative that was there in the first couple of months of the year, we have gone to a surplus, where now we are speaking about an excess surplus rather than going back into the deficit. So the entire platform has been set by the RBI governor saying that as per the monetary policy, whatever we could do, we have done. Now it is on for the economy and the government to take on the growth from here.
Right. So, what started as a common goal back in 2020 to, curb inflation and have a very similar sort of actions. It's okay that, right now we are seeing that clear divergence. So then my next question is that, what are a few triggers? What's next that, might prompt further, the central banks for, say, RBI for easing or a pause, and what must happen, what could happen, say, in the US for Fed to pivot from this pause. So what are a few triggers that you could say? So what your outlook is for the next versus in both the cases for US Fed as well as in the RBI?
So for US, it is very clear that they are not waiting for as such they're waiting for the hard data as per the speech and everything that we are seeing, and they're only scared out of the entire scheme of things. As a central bank, if you see, they're looking at three factors, that is your growth, inflation, and unemployment. Now, two factors are certainly to weaken. That is your growth is likely to weaken, and your unemployment is going, it's still stabilized because the immigrants are coming in less for the jobs, applying less for the jobs. Therefore, the job vacancies which are getting created are not the new openings, but the existing ones that are opening are getting filled. So therefore, the labor market is getting stabilized. But in larger scheme of things, because the growth slowdown will come, the unemployment will also increase. Now, the third factor which Fed is more worried about right now is inflation. But again, in the press conference, if we listen to the speech and if we, pay a closer attention to it, which he's mentioned before also, the way to look at the inflation is to segregate in two parts. One is that you look at the goods inflation and how much it is contributing. Is it on a rising trend? But is good inflation really demand driven? No, it is a supply constraint, and it's not something that is creating a really positive momentum in the economy. The other part that you would, which he pointed out, the services inflation is slowing down. And when we say that services inflation is slowing down, that means that there is less demand for the services which is already pre-existing in the economy, does not depend on the external factors or geopolitics. And similarly, the housing market is also cooling over there as of now. The contracts are coming down for the housing market. So going ahead, they will take a call on whether they want to take this as a one of the decision that, okay, this is one time rise because of the supply constraint, and we may just want to, be more realistically and approaching this and concentrate on unemployment and growth rather than something that is not controlled and is not in our hand. But having said that, they still seem to be keen on seeing the impact of the tariff, which is what they said that we will watch the summer numbers. So if those are comfortably, even if it reaches 3% and it is not exceeding or getting closer to 5%, I guess that they will pivot from the decision of staying on hold. Maybe we see that the change in the tone happens in next policy, and then as estimated in the dot plot, it becomes 25, basis points cut this year. But the trigger has to be an inflation. They need to get a comfort on the inflation number. Probably they'll change the narrative after that. For domestic, now if we see the forecasts which are given, they are pretty realistic forecasts. So we brought down our inflation forecast to 3.7%. And to go down below that realistically might not be feasible for this year, given that there could be some disruptions because of the crude or any other raw materials that could be there. Other than, and your growth slowdown, if it comes drastically down, 6.5 is the estimate. If it comes below 6%, then that might be a trigger, but that remains to be a watchful. Other than that, only if we see that suddenly something turns around in the US economy and Fed pivots, then that opens up space for us for the, further rate cuts. But we don't see that at least upcoming policies will see any action. It would be more a status quo and more on liquidity announcements or around, those things.
Right. So what we can make out is that Fed is looking for more consistency on the inflation numbers and this is more of a precautionary step, the pause, due to what impact the tariffs could have, because right now
Absolutely.
they are on a pause, but someday they will unpause, and the impact would come. And for RBI, for at home, it looks like the front loading has done whatever they can to control the inflation. Now the stimulus is on the growth, plus liquidity could manage further, the yields part on the domestic part. Sure. So now, coming to, what's the impact on the Indian markets, especially the fixed income market, with, like you said, we saw the CRR thing by RBI. There's also, more and more OMOs being done, open market operations being done by RBI, which are aimed at, injecting liquidity into the markets. And the global yield volatility is also rising. So, what should, investors expect in terms of Indian government bond movements and particularly the currency direction or the rupee direction going forward?
For domestic investors in fixed income, as per se, see, the market works on expectations, right? And by front loading a 50 basis, which was expected in a 25 basis, and change of a stance has kind of killed the market expectation right now that there could be much that could happen around the rates. So duration has become a bit of a sell-off at this moment, but investors have to also look into the fact that if there is a front loading of the rates happened at such a aggressive manner that we have done it only in, like, few months, then there is a real slowdown that the investor that the government and the governor might be seeing it, which is why they front loaded the rates. Having said that, there could be a interest back in the duration once we see that slowdown numbers, in concrete numbers. So in India also, it remains the story of a hard data coming in. And once we see that that slowdown is happening again, then the fixed haven of India, which is sovereign bonds, the interest will come back of the investors over there. So as for India investors right now, what they need to look at, where are the opportunities across the yield curve. So currently being on the shorter end of the curve would be beneficial, because there would be spreads advantage which would play out. But at the same time, an investor needs to keep an eye out that where the things are turning around, because on the extreme end of the yield curve, because there is a sell off, there are good spreads which are available, which an investor can monetize it, invest right now and take the benefit of it when the actual narrowing of the spreads happen, when the interest comes in. So right now fixed income market has become very tactical and spread based, I would say, rather than can be in any duration specific.
Right. So that is what my, the next following question was that, what do we look at? Do we, because there is US policy rigidity is over here, and, we have front loaded in domestically. So where it is wiser to lean on? To this the short duration side, or, look at the duration. If, say, if an investor has a portfolio in the fixed income space, what would be your recommendation to look at on first, let's take the duration side that, where in the duration bucket do you see juice right now?
On a tactical call on a duration, if you see a spread between a 10-year and a 30-year, or a corporate bonds have widened drastically. So extreme long, where an investor has a patience to stay invested through the volatility. Extreme long looks very good because of the spreads that are available. 10 to 30-year or 40-year spreads are almost at a 70 basis points, which is not a normal course in let's say rate cut is not happening, but a rate pause cycle also. So I would recommend there go extreme long. So we are recommending right now kind of a barbell, go either extreme short or go either extreme long. The mid of the curve does not suit right now. On a on non-duration side, would recommend that be on the shorter side, be in the curve where 1 to 3 year is there, because there the steepening is possible. Your extreme what do you say, like a liquid fund has already priced in the rate cut of and CRR cuts, and your 5 year is somewhere on the flattest. So the steepening is possible in 1 to 3 year. And in this sweet spot, you can look at the funds like low duration, ultra, or short term funds. These are the categories which you can look at.
Right. So, in all the viewers, who are keen on, asking the questions, you can type in, in the Q&A section instead of a chat box. So, we'll be taking all the questions towards the end. Kruti would be here to answer all your questions. So, my next then question, Kruti, the follow-up question would be that, say, in this current environment, do you also feel the case for corporate bonds? Or only the money market? So there are three segments in debts that we particularly talk about. There's the money market segment in terms of instruments, there's the corporate bond segments, and there's the government security segments. Which of the three segments do you see, if there's only juice in one of these segments, or if there is juice left in all of three? So which space in these segments, 10-year space, 5-year space on the G6 side, where in the money market segment, or also towards the corporate bond segment? So what's your take on that?
So there is each segment which has opportunities. It is about, seeing it in which bucketing you want to do. So for example, again, if you want to see GSEC, you see the extreme long because the spreads are compressed to widened over there, and there is a possibility of compression. But there will be a lot of volatility in that segment because it's a longer duration. It is not a shorter duration. So the risk appetite has to be of an investor to go through that volatility. In a corporate bond segment, you can look at 1 to 3 year segment where there will be demand, because this is a very sweet spot where you don't have a duration risk, and nor do you have that much of the liquidity fluctuation risk, because liquidity also in the system is a cycle where your liquidity comes in and goes out as per the government spending, your GST flows and everything. So this becomes a sweet spot where there is an uncertainty of what to happen next. And in money market also, now because your extreme short, that is your up to 3 months, has priced in the repo rate. If you want to go in for a better accrual or a spread, one has to look at uh, accruals, I would say. So it's time again that in a growth phase, you can look at some of the on the shorter end accruals which has slight credits in it, so that you have a higher accrual at this point of time. And in that, you can look at a segment of, let's say, 6 months to 12 months or 9 months to 12 months, looks like a good spot to be in.
Right. So, you already answered this question here, and I would like to take you towards the next part, that ultimately, how are we at Mirae Asset positioned to sort of capture the very opportunities in different segments that you talked about, say corporate bond, money market, and G6, and which are the particular funds that you would look at this time, or categories, not only just Mirae Asset, or categories you would look at that could be uh, uh, actually at a very opportunistic point to capture the whole fixed income landscape.
So, let's just start with the basics. See, there are two cycles. There is whether it's a rate cut cycle or a rate hike cycle, correct? If you are in a rate cut cycle, your call becomes much more easier because you know that the yields are incrementally going to go down only, and you can take a good call in duration. There you don't have to think much. You just have to invest in good assets because the yield curve itself moves down, whether any category that you are in there. And as an investor, you take your risk call that whether you want to be in the longer end or a shorter end. Now, the complication comes when you are in a rate hike cycle because the yield curve is likely to move up. How do you make the best of the yields moving up? We are in neither cycle right now. We are in a pause cycle. We are not, because rate cuts are also a little far away and rate hike is out of question as of now. In such a situation, an investor should be looking at, so we are not seeing a yield curve entirely moving up as of now. We are expecting a range bound. Now, in this situation, it becomes tactical where you want to be positioned according to your risk appetite. it could be a good time to look at some of the accruals again to, increase the exposure. And again, in that, within that also, you have to see that you are not in a cycle where the credit risks are very high. So currently we are in a growth phase where the credit will also be supported. So you can have a moderate exposure to that, because there would be a support, because there is a support for the growth in that segment. So depending on your risk appetite, you can place yourself in the shorter end where there could be some good accrual opportunities. Let's say like ultra, or again money market, or low duration kind of a category. If you want to play corporate bond spreads and you want to see that category where you maximize the narrowing and the widening of the spread, then you can look at a short duration. And if you want to play safe and you want to play sovereign, then you look at a yield GSEC yield curve where you see the maximum spread that is there. So right now we see that in the long duration where the maximum spread is there. Each one again has its own pros and cons, and investors should look at their risk appetite before investing. But you can obviously keep an eye out for shorter before, and then when you see an opportunity, move to the longer end of the curve.
Right. So, now my question directly to you is that, if you had to say, you had to not, for any investor, you had to pick out one single fixed income fund today, what would be your recommendation over there? As per, your risk appetite.
But
Of course, not from the mirror asset universe, but, what category would you be looking at right now?
because there is so much happening and there is so much activity happening, an investor, if is an active investor, can look at switching between the funds. But if an investor wants to invest and leave it to the fund manager to decide where they can move in, one category that an investor can definitely look at is income plus arbitrage fund. Now the beauty of this fund is that the fund manager will take call on the duration. So if right now the shorter end of the curve is doing better, your money gets invested in that. When there is an opportunity in the longer, your money gets automatically shifted towards that. Or there can be mix of various funds. You don't have to think as an investor that what proportion to put at. And one more advantage is that the taxation benefit is there in this. So you have kind of best of both the worlds, where the dynamic fund management is happening in the debt category, and you're getting a taxation of equity in 2 years. So this is a beautiful product to be in right now.
Right. So this space makes it best of both, debt and arbitrage brings in the stability plus the tax efficiency of, if the investment holding period is above 24 months of 12.5%. So very well. So with that, I would like to open the floor for further questions. So we'll take a pause here, and viewers, if you have questions, you can, put it in the chat box, or sorry, the Q&A box. My bad, my apologies. Right. Right. So we'll start with it. So Kruti, the first question is from Mr. Rahul. So his question is that why is the 10-year yield not going down even after this front loading of, 50 basis points? Can we still play the duration for returns point of view in the next 12 to 18 months?
Very apt question, Rahul, that why the yields did not react to the front loading. But the reality of any market is that market works on expectation. It does not work on the deliverance. And one of the important part about it, that is that the investor always have something to look forward to. Sadly, in the policy, the stance change that mindset that there is no more to look forward to. But again, like we went in our discussion previously, that the front loading could also mean that there is a slowdown which is expected. And this is because despite this front loading, we did not up our GDP estimate. We maintained our GDP estimate at 6.5. So it is expected that even after such a front load, there is going to be a challenge in matching that GDP growth. So yes, there will be an opportunity in next 6 to 12 months in duration, but you will have to wait down for those initial hard numbers to come in, that there is an actual slowdown, and then we will see that the investors will return to the fixed income market.
Right. So, on to building on this question, Mr. Devraj Singh has a question that, on the duration of investments, particularly, besides the 10 to 30 year tenure, is 3 to 5 year tenure apt for investing, considering that the short term has already priced in the CRR cut, probably what you mentioned even in your presentation. So, what's your take on the same?
The CRR is a function of liquidity, and liquidity means up to 1 year is somewhere it plays out. So we have seen that it has played out up to the 3 months, but in 9 to 12 months there still seems to be flattening that can happen. Now on a corporate bond side, I guess it was corporate bond or it was GSEC. I don't recollect.
I think it was GSEC. Yeah. The instrument is not mentioned. It's corporate bond. So sorry. Yeah, it's
Corporate
corporate.
bonds. So
Yeah.
if you see the yield curve of the corporate bond, your 3 to 5 year is flattish. So from there, if we are expecting that liquidity has to play out and transmission has to play out, then your 3 year has to go down, whereas your 5 year might remain there or go slightly up. So which is why we see that there is more scope in your 2 3 year segment rather than in a 5 year segment. And then we see that the extreme long of the yield curve will play out better.
Sure. So the next question is from Mr. Yogesh. What's your outlook for inflation? Likely positive supporting it and likely negative weighing it on it.
Inflation should not be concerned for us this year, because if we have to look at the factors that influence inflation, is 45% is in food basket. We have good production this year. We have good reservoir levels well above the 10-year average. And we have good buffer stocks also maintained in wheat and rice. The procurement has been done beautifully this year. So we don't see that the food inflation is going to go very higher this year. There could be a slight threat from the Brent going higher, but again, there is another angle to it, that there is not adequate demand also for the energy, because the global growth is expected to slow down in itself. So we don't see that energy prices can pose that of a threat that we move our inflation estimates in a negative way. Inflation can become a concern next year, and not because there would be a high inflation, but because the base effect has come in and the inflation has gone down to a level of, let's say, below 4%. So because this base effect will play out, we will see the numbers being higher next year than what we are seeing in the range. But as for this year, we don't see that any major uptake or any disruption that can take place in inflation.
Sure. So, an interesting question by Mr. Sumit Saxena. So that if one needs to create a basket of 2 to 3 fixed income, products, mutual funds, I'll assume, for the next 3 years, which categories would you recommend to make that basket?
For 3 years.
For 2 to 3 years, yeah.
For 2 to 3 years. Okay. If we have to make a basket for 2 to 3 years, I would recommend one that you go for a dynamic, or you can go for an arbitrage. 2 years, if you're doing 3 years, and an arbitrage kind of a fund would be a beautiful set in over there. Second fund, I would recommend that since India's story is playing out so strong, and every economy which progresses sees that the rate, goes down incrementally, the longer side of the yield curve, that is your 30-year and plus segment of a GSEC, can be looked at, because that will structurally go down over the period of time. And third, for the liquidity purpose, so that, in case, because fixed income has to provide liquidity in the shorter tenure, there could be a 1 year product which could be part of your portfolio, just as a replacement of your savings account. Rather than having a savings account, you can have a part of a 1 year product that could be either ultra or money market in your portfolio.
Sure. So, on more on it is question by Mr. Jeet Sudani that, for a moderate risk appetite investor, where then can they invest for a longer term horizon, say, let's say 5 to 10 years, particularly in the, debt mutual funds offering?
For a 5 to 10 year product.
Yeah.
Uh, the investment horizon is 5 to 10 year, or The
Yeah, the
segment.
investment horizon is 5 to 10 years.
If investment horizon is 5 to 10 years, I would recommend either go for a again arbitrage or dynamic kind of a category, because there would be rate cycles would be coming in, and you would want that to make the best of the active management. And second, again, I would recommend that India is a structural story. If your investment horizon is so long, then go for a long duration product
Right. So long
and term.
duration fund probably, and since you said, dynamic and arbitrage, even income plus arbitrage as a category would also
Correct.
make
So,
sense. They
right.
would also get that benefit of, equity like taxation in this FOF sort of a structure.
When I said
Right.
I meant income plus arbitrage fund.
Right, right. Sure. Sure. So another question is by Mr. Sunil Lokhande that, where could the 10-year government security yields could be going, post this moment? Because I think there's no scope for much scope left for the RBI to, go for another rate cut. So where do you think it would be in a range-bound manner, or, further down, or would be stagnant at these levels?
So if there are some more negative flows, news coming in because of the geopolitics, or there are disruptions which are happening, which eventually will come down. But when there is heat in the market, there is a sell off. There is a possibility that your 10-year might go to 640, 645 levels. But therein, when we see that in next 6 months things calm down and there is more certainty in the market, we will see that this will again come closer to 620-25 levels in next 6 to 8 months probably.
Sure. So another question is by Mr. Sarvesh that, with India's stronger macro position, do you think bond yields could still overreact in the short term if oil prices rise sharply due to the whole geopolitical and Middle East situation? So is the market more, the fixed income market, I'm assuming here, more market sentiment driven than actual, fundamentals?
There would be sentimental bit of it. Every market works on sentiment. So till there would be developments or the incoming developments and predictions about what will happen next. And because India, so over the period of time, obviously our dependence on the oil movement has decreased drastically, because we have moved towards more renewable energy. We also have, diplomatic relations with a lot of economies where we can get oil for a better price. But having said that, some impact will be there. It will not be as drastic as it used to be in the past. We will not see that for every $2 movement here, the volatility is of a 5 to 7 basis points. But that 1 to 2 basis will be there in the market because of the volatility.
Right. So I can see a lot of questions on the income plus arbitrage, category. So what is, all this about? So I'll take a moment and just explain what this category is about. So it's a fund of fund category or a scheme wherein minimum 35% each is, invested in actively managed schemes of debt and arbitrage. So these two asset classes, debt and arbitrage, come together in it, whereas, the debt side is managed, like Kruti mentioned, on the very dynamically based on duration or accrual as per the outlook the fund manager has. And on the arbitrage side, you have, very market neutral, actively managed arbitrage fund. So this fund combines the strength of and the stability of both income plus arbitrage. So the debt plus arbitrage, sorry. So hence the category named the income plus arbitrage. Right. So Kruti, let's take a couple of last questions. So, Mr. Saurabh has a question that, how do you hedge the portfolio at this current juncture with, so much of volatility in the markets? I believe he's referring to the equity market. So, what can be seen to hedge from a fixed income point of view?
Because there is so much volatility, so these two products are two different, catering to two different needs.
Right.
One is that your equity is a wealth creation, whereas your fixed income has to be your wealth preservation, kind of a category for you that helps you in any situation. So because there is a volatility in the equity markets, investors can right now look at diversifying into some of the fixed income products. And when we say we want those products to be fairly stable, or not be very volatile, And because we don't want it to be volatile, we would recommend that you stay on the shorter tenure because you're talking about hedging your risk. So again, there you stay up to 1 year product or maximum 3 year product if you have a little longer investment horizon.
Right. So another question by Mr. Ganesh Ramachandran, that is there a chance for another 25 basis point rate cut towards the end of the year domestically? And if there is a rate cut, how would the long duration category, poised to perform? Maybe not on the return side, but would the long duration category be beneficiary if there's another rate cut towards the end of the year in India?
There could be a possibility of a rate cut of a 25 basis if the growth undershoots. I don't see inflation undershooting the target, but if there is a remote possibility of growth undershooting or Fed aggressively going on a rate cut cycle in 2025 itself, then we see that. Will long duration perform? If there is a slightest assumption also, or the market rumor that there is going to be a rate cut in the market, or we see the early signs of it, I would say in the assumption of it, the long duration will perform. But once it is delivered, again, the market will circle back to what next can we expect. So I guess when you want to play that tactical call, you have to play on the assumption rather than the deliverance of it.
Right. Hence the portfolio, looking for a portfolio way through mutual
Yeah.
funds, right? So before we sum up the, a tale of two central banks, taking the last question that, if the US 10-year yield goes towards 5% or more, which happened, I believe, last year only. So how would it impact our 10-year GSEC? And, if will there be any impact on the fixed income markets per se if that event sort of happens hypothetically?
Hypothetically, if US again goes to 5%, yes, your Indian markets will also react to it. But again, if last 2 years has been, or last 1 year has been any, teaching for us, is that the volatility has drastically decreased compared to what it used to be previously. Yes, there will be some impact. So if US goes to, if US is moving 10 basis points, maybe India is moving by 2 to 3 basis points. It is not moving all the way 15 basis points what it used to be before. Impact will be there. There is no denying over there, but it will be much less.
Right. So, Kruti, any summarizing comments you have with respect to both the central banks or, the fixed income space or any funds? Any summarizing comments that you have?
So for fixed income space, yes, the commentary looks like, lot of it is done. But rest assured, it will be back in the flavor in upcoming months. Till then, look for the opportunities, look for the categories, look for the spreads. There are a lot of investing opportunities because you don't invest when the cycle is done. You invest when the cycle opens up, and this is precisely that time that the investment opportunities have opened up again, and you can lock in yields at good levels. For products, what we place it that play the shorter duration first, and when the opportunity opens up, go towards the long. And if you don't want to go through that entire process of selecting, then take products like income plus arbitrage, where the fund manager does it for you. But yes, the fixed income market, the cycle is not yet done. It's paused. And the investment opportunities have just opened up again over here.
Right. So I would summarize it that, don't put all your eggs in one basket. So that is why we have two asset class predominantly in India, the equities and the debt or the fixed income. So thank you so much, Kruti, and thank you so much, viewers, for joining us at Mirae Asset Mutual Fund. We keep on doing such knowledgeable webinars, on FOMC or the RBI MPC or monthly outlook. So watch this space for more. Thank you, Kruti.